Something happened today that does not happen often. Surprised, oil fell. Peace signals came out of the Middle East. Geopolitical risk premiums started unwinding. Oil traders who had been positioned for a prolonged disruption began booking profits. WTI dropped, and silver went up. Silver touched $90 per ounce today. On the same day oil was falling. That is not a normal correlation. That is not noise. That is not a random price fluctuation on a volatile day. Curious. That is a signal. And understanding exactly what it means is the entire point of this video. Stay in. Every part of this builds on the next. To understand why today matters, you need to understand what the silver market has been doing for the past 10 days. For the past 10 days, silver was moving in lockstep with energy market fear. Every time a headline hit about the Strait of Hormuz, silver got a bid. Every time oil pushed higher on Middle East tension, silver moved with it. The market was treating silver as a geopolitical safe haven, similar to gold but with more sensitivity to the energy shock narrative. That was the trade. Oil fear goes up, silver goes up. Oil fear comes down, silver should come down. That is the logical textbook expected relationship until today. Today, Trump used language that implied the military engagement driving the oil disruption was, in his own words, very complete. Markets read that as a peace signal immediately. Oil traders unwound, risk premium collapsed, oil fell, and silver did not fall with it. Silver opened, found buyers, and touched $90 per ounce for the first time since the initial geopolitical spike. When an asset breaks its correlation with the macro narrative that was driving it and moves in the opposite direction, it is telling you something precise. It is telling you it has found a new reason to move, a reason that exists independent of the old catalyst. That reason is physical supply, and the mathematics underneath it. Let us build the physical picture from the ground up, because the structural argument for silver does not need geopolitical fear to hold. It holds on its own. JP Morgan recently purchased 3 million ounces of silver, average price $78.29 per ounce. They bottom-ticked the market. And then, in the same window, they moved 169 million ounces of silver out of deliverable vault status into non-deliverable status. Read those two actions together. Buy at the low, then remove supply from the pool available for futures delivery. That is not a coincidence. That is a sequence. Now here is why the scale of that move matters. The total registered inventory on COMEX, the metal actually available to settle futures contracts, sits at approximately 86 million ounces. JP Morgan moved 169 million ounces into non-deliverable status. Nearly double the entire exchange's deliverable supply. Removed. Locked away. Unavailable for future settlement. Now layer the open interest figure on top of that. Current open interest on silver futures is sitting at approximately 244% of registered inventory. That means for every single physical ounce sitting in COMEX registered vaults, there are roughly 4.65 paper contracts written against it. 4.5 claims for every 1 ounce that can actually be delivered. If even a fraction of those contract holders stand for physical delivery simultaneously, COMEX does not have the metal to satisfy them. That is not a theoretical problem. That is a mathematical certainty operating in real time. And here is the point that the peace news does not change. Trump's statement that the conflict is very complete does not move 169 million ounces back into deliverable status. It does not restore COMEX registered inventory. It does not change the 4.65 to 1 paper to physical ratio. The geopolitical risk premium on oil can collapse completely, and the COMEX delivery math remains exactly as stressed as it was before the peace signal. Oil and silver were correlated by sentiment. They are not correlated by structure. Today, the market began figuring that out. The Eastern physical market has been saying this for weeks. Physical silver in Shanghai has been trading at a $12 premium over the COMEX paper price. Buyers in Asia were willing to pay $12 more per ounce than the New York futures price just to get real metal in their hands. Arbitrage should close that gap. It is not closed because the metal is not physically available to move from west to east at the speed the market requires. When a $12 arbitrage gap persists in a global commodity market, the paper price is not reflecting physical reality. Today's move to $90 is the paper market beginning to close that gap, not because of fear, because of supply. Now the relative value picture, because this adds a second independent framework to the same argument. Gold is currently trading at $5,220 per ounce. Silver is at $90. The gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, sits at approximately 58 to 1. That number has a historical context worth understanding. In the 1980s, during the last major commodity stress cycle, the ratio compressed to 15 to 1. In 2011, during the last sustained silver rally, it compressed to 32-1. Today it sits at 58-1 and it has begun moving lower. The math of partial compression is straightforward and we are going to be precise about what it is and what it is not. These are not price targets. These are historical ratios applied to current gold prices. If the ratio compresses to 45-1, a conservative move by historical standards, with gold holding at $5,000, silver's mathematical position is $111 per ounce. That is approximately 25% upside from today's price. Without assuming any delivery default on COMEX, without assuming any new geopolitical shock, without assuming any further institutional buying, just a partial normalization of a ratio that has compressed twice in modern history under conditions less structurally stressed than the current setup. If the ratio moves to 30-1, well within the range of what has happened historically, silver at that ratio with gold at $5,200 is $173 per ounce. These numbers are not invented. They are the arithmetic of where silver has traded relative to gold before, applied to where gold is trading today. The institutional side of this picture adds a third independent data point. Bank of America has published a silver price target of $309 per ounce. Not $90, not $100, $309. Bank of America does not publish a target like that because they are guessing. They publish it because their supply and demand models and physical market analysis indicate silver is severely underpriced relative to where fundamentals should place it. JP Morgan's behavior tells the same story from a different angle. They bought 3 million ounces at $78.29, the low, and then moved 169 million ounces out of deliverable status. The institution that settled $920 million in federal precious metals spoofing charges in 2020 is now positioned long on silver and has reduced the deliverable supply available to everyone else. That is the playbook. Understanding the playbook before it completes is the entire point of tracking this data in real time. The structural supply picture underneath all of this does not require any of the above to be true. It stands independently. Silver demand is split roughly 60% industrial and 40% investment. Solar panel manufacturing is consuming silver at record levels as panel efficiency improvements require higher silver content per unit. Electric vehicles use significantly more silver than combustion engine vehicles. AI hardware manufacturing, advanced chips, high-speed data infrastructure requires silver for electrical conductivity in ways that did not exist as a demand category in any previous silver cycle. The Silver Institute has documented several consecutive years where total global demand exceeded newly mined supply plus recycling combined. That is a structural deficit. And on the mining side, the largest primary silver producers have been cutting production guidance due to declining ore grades, rising operational costs, and energy cost pressure, flat supply, rising industrial demand. Institutional players removing deliverable inventory, paper to physical ratio at 4.65-1, Eastern buyers paying $12 premiums. 5 separate data points from 5 separate sources, all pointing in the same direction. Here is what to watch over the next 48 to 72 hours. Watch COMEX open interest. If open interest stays elevated above 200% of registered inventory while price continues rising, we are entering a delivery pressure environment that the paper market cannot manage quietly. If open interest starts declining without a corresponding drop in price, shorts are covering. That is structurally bullish. Watch the gold to silver ratio. If it continues compressing below 55-1, that is a strong signal silver has entered a sustained outperformance phase relative to gold. Below 55 tends to move toward 45 faster than the move from 58 to 55 suggests. Watch the DXY. Silver is priced in dollars. With oil falling and geopolitical risk unwinding, the dollar's next direction is genuinely unclear. Dollar uncertainty benefits hard assets. A confused dollar is historically a tailwind for silver. Watch any new COMEX delivery filings. If a large institution files for physical delivery on March contracts, the market will need to reconcile 4.65 paper claims against 1 physical ounce in real time. That reconciliation does not happen slowly. The bear case is real, and we are going to give it to you directly. Paper markets still dominate short-term price discovery. A reversal in Trump's peace language, a single headline suggesting the conflict is resuming, could trigger algorithmic buying in oil and selling in silver simultaneously. The DXY could catch a bid on safe haven demand if risk assets sell off broadly. Any of this week's data prints, and the calendar is loaded, landing in the wrong direction hands paper sellers exactly the narrative window they need. The $85 level was rejected multiple times before today's $90 touch. Until silver closes above $90 convincingly and holds it on a daily basis, $90 is a touch, not a floor. And for anyone using leverage in this environment, silver can move 10 to 15% in either direction in a very short window. Leverage amplifies losses with the same force it amplifies gains. The structural case being intact does not protect a leveraged position from short-term volatility. Size accordingly. Here is what today confirmed. For 10 days, silver moved with oil. Today, oil fell on peace news. Silver went up. That is the decoupling. Not from a price, from a narrative. Silver stopped moving because of geopolitical fear. It started moving because of physical scarcity, because of 4.65 paper claims per deliverable ounce, because of 169 million ounces removed from deliverable status, because of a $12 Eastern premium that arbitrage cannot close, because of a gold-to-silver ratio that history says cannot stay at 58-1 indefinitely under these conditions. None of those structural facts changed today. What changed today is that the price began reflecting them. That is the signal worth understanding. Watch COMEX open interest daily, public and updated every session. Watch the gold-to-silver ratio. It is a live number available on any data terminal. Watch the COT report every week. Public, released by the CFTC, the most direct window into institutional positioning in the silver futures market. Watch the SHFE vault data and the SGE withdrawal figures. The Eastern physical market has been pricing this story for weeks before the Western paper market acknowledged it. Verify every data point we have shown you. The JP Morgan purchase figures are on public record. The COMEX registered inventory reports are updated daily. The Bank of America price target was published and is documented. The data is public. The mechanics are understandable. The only requirement is the discipline to read them without letting price action drive the conclusion. Invest with logic, not hype. Market Crux, signing off.